Well, good evening, everyone. It's just after 8 p.m. in the East and 5 p.m. in the West, and we're here for Enrichment 2019. This is session 5. Wow, we are getting through it. This is session 5. Welcome tonight, and we are looking at wise financial choices, saving for retirement. And I am here with Mike Crofts.
Go Boston, go!
No, bad.
Welcome, everybody. Good evening.
All right, so we're just going to dig right in. We got a lot of territory to cover tonight. We're going to look at wise financial choices, saving for retirement. This is the key question that people tend to think about when they think about financial planning. If you are someone who's been following what we're up to here in Enrichment 2019, you'll know that that's actually the next step after the foundational steps of getting our financial house in order, getting our financial plan going, getting our cash flow going, getting rid of our debt, and other steps that we take, setting up our emergency fund, all that good stuff. Once you've got all that foundation laid, then you can start looking at saving for retirement. And so in saving for retirement, there's really one key question that helps to frame that discussion, and it is this. How much money am I going to receive monthly to live on in retirement? And how will I receive that income? You know, people think that there are all sorts of fancy questions they need to worry themselves about, and we're going to talk about some of these next week, things like fees and should I be in ETFs or index funds or et cetera, et cetera, et cetera. But you know, when you get down to the time that you are going to retire, this is the key question. How much money am I going to have? And that is how we have to design our financial planning. That's how we have to make our wise financial decisions around retirement, is with that question in mind. So how much money am I going to receive monthly to live on in retirement? How am I going to receive that income? And there's a piece that goes with that is how certain am I that I'm going to receive that income? Because, you know, even though you can go and be a greeter at Walmart now as you're well past retirement age, and McDonald's is hiring senior citizens, you know, if you run out of money when you're 89 or 92 years old, it is a grim scenario. You are going to have to rely on the kindness of others, because it gets very difficult to be drawing an income at that stage of your life. So now retirement has taken on a number of different shapes, and we want to frame the question in that context. So the real question is not this word retirement, which kind of brings with it this weird thought of I'm going to be wearing plaid shorts and eating dinner at 4:30 and playing golf every day. That's really not at all what retirement looks like anymore. And so the real question behind that is, when will you shift from living on the money that you earn by working to living on your savings? So we all set out, we make an income, and that's what puts food on the table, a roof over our head, and we run our finances that way. Eventually, we want to get to a point where we no longer have to work in order to eat, but instead we are going to be living off our assets and drawing an income from that. Another key part of that is how much of that income is going to be lost to taxes. And that is an essential part of the early stage of retirement planning, because the decisions you make as you begin saving are going to have a dramatic impact on how you live when you shift to living off your assets and drawing that retirement income. And then, of course, one core question to all of that is, how much do you need to be saving? How much do I have to be accumulating? And we're going to look at that in a very specific way on our session on Tuesday. We're going to look at a calculator that we use to come up with exactly that precise number. But we know that as a general rule, we want to be looking at somewhere around 15% of our income. We talked about this earlier, that Canadians used to be great savers. Now, not so much. Canadians used to be saving as late as 25 years ago. We were saving 20% of our income. Now, on average, Canadians are saving less than 1% of their income. And so we're going to take a close look at that. All right, so these are our 3 questions that kind of frame exactly what matters in this. Now, we're going to start with looking at the different types of investing vehicles or formats that we can put our investments inside. And it's really critical to understand this. And one of the key questions we get asked all the time, you see lots of debate about it, is tax-free savings account versus RRSP. Which is the right place to be saving my money for retirement? And so there's not necessarily only one answer to that, but there is a general rule of thumb that does apply to most Canadians. And so we're going to have a look at that. Now, for those who aren't familiar, a tax-free savings account and an RRSP, both are just containers for investments. And hopefully you've downloaded and got your workbook out and you're following along in there. Because we're going to address directly the questions that are in there. So both RSP and TFSA are just containers for investments. People often get confused on this. The 2 containers have special tax treatment that the Government of Canada has designated for these 2 types of savings buckets, if you will. So RRSPs and tax-free savings account can hold exactly the same type of investments in each of them. Now, each of these containers has a certain limit that's determined by rules. And your RRSP limit, for example, or sometimes referred to as contribution room, that increases by 18% of your income. So the amount of RRSP room that you have available is tied to your income. And so each year, your available room to invest in an RRSP increases by 18% of your income up to a maximum. And the maximum increase for 2018 was $26,230. Now, your TFSA limit is a completely different number. It is a fixed amount that currently increases each year by $6,000 plus a minor inflation adjustment. Now, the current total contribution limit in 2019, so the current lifetime total contribution limit in a tax-free savings account is $63,500. Now, the tax-free savings account is not just a savings account. Unfortunately, it has a name that tends to deceive people. A lot of people think that a tax-free savings account can only hold a typical savings account. And we know that those are not earning a great rate of return right now. But that is not correct. A tax-free savings account is an investment account with special tax treatment, and you can hold the same types of investments in your tax-free savings account that you can hold inside an RRSP. Now, there is some difference in the way that these things are treated from a tax point of view. An RRSP, the contributions we make in there are tax deductible when we make the contributions. So most people tend to experience this as a tax refund when they file their taxes. Now, with a tax-free savings account, you don't get a tax deduction when you contribute. So you're using what we call after-tax income to contribute to your tax-free savings account. For both of these plans, tax-free savings account and RRSP, there is no tax to be paid while these plans are growing. So as long as you've left the money inside these plans and they continue to grow and accumulate and compound, you do not pay any tax. You only pay tax when you withdraw from an RRSP. So here's how the tax treatment of withdrawals works. And remember, the whole point of these plans is to save for your future. So this is the key consideration. Remember, I said at the beginning that we want to start out with our investing as we intend to continue with it, so that when we get to the time of withdrawal, we're going to be getting the amount of money that we're anticipating. Now, RRSPs have the worst tax treatment on withdrawal. 100% of what you take out of your RRSP is taxed as income. So you pay income tax when you're living on this money in the future, and you pay it on 100% of what you withdraw at your then marginal tax rate. A tax-free savings account, on the other hand, are tax-free, just like the name says. So when you take money out, you no longer have to pay any tax on it. Another interesting little side note is that if you take money out of your tax-free savings account, the contribution room attached to that becomes available again. Whereas when you withdraw money from an RRSP, that contribution room is gone forever. Another key consideration with RRSPs is that you are compelled to withdraw the money starting at age 71. The government is going to get its tax money eventually. And so we are compelled by regulation to withdraw money at a minimum prescribed rate starting when we're age 71. So TFSAs are tax-free, just like the name says. So in the majority of cases, you should fill your tax-free savings account first. There are a few exceptions to this, but not many. And making this decision requires good tax planning. Now, that can be a very controversial point of view. There's a lot of debate about that, but I want to show you why I say that. And again, I'll caution you, this is general advice for the majority of people. In some specific cases, it may make sense to contribute to an RRSP first. But in most cases, you're going to want to contribute to a tax-free savings account and fill that first. Now, let's look at an illustration of why that is. Here's a simple way to understand investing in RRSPs versus tax-free savings account. Think of two farmers. They're equally successful at producing a crop. Now, the farmers live in a great land with many taxes, and they have to pay tax on their business. But they do have a choice as to when they pay that tax. Now, of course, we all know that a crop is grown from seed. And so farmer A makes the choice to pay tax when he starts out. He takes $5,000 worth of seed, and then he has to pay tax on that when he plants. And let's say the tax rate is 25%. So the farmer buys $5,000 worth of seed, and when he buys it, his $5,000 worth of seed, he has to pay 25% tax, which would be $1,667. So his total cost is $6,667 to get his $5,000 invested in working. Now, over time, his crop grows, and let's say in this case, it grows to $75,000 worth of crop. Now, he paid tax when he started out, so he has no tax to pay now when he harvests and goes to enjoy living off his crop. So in this case, he's gained $68,333 to live on. That is, he's started out spending $66.67, and it grew to $75,000 was his yield. So $75,000 minus $66.67 left him with $68,333 in gain that he is living on. Of course, he still has his original $5,000 investment in there as well. Now, the second farmer decides he's not going to pay tax until his crop comes in. So he takes his $5,000, he buys the same amount of seed as farmer A and plants it. Now, he also has an additional $1,667 to spend today because he's not paying his tax until his crop comes in. So whereas farmer A had to commit $66.67, farmer B only had to commit $5,000, and he has that extra $16.67 to enjoy spending. Very similar to what people do when they contribute to an RRSP. They get their refund from their contribution and they go and spend it somewhere else. Now, the second farmer's crop that he put $5,000 into grows the same rate, 15 times what his seed cost was, and gets the same success at growing as farmer A. So he has a crop of $75,000 as well. Now, he has to pay the tax. He's not feeling worried because he's relaxed after his vacation in Hawaii that he bought with his 1667 that he didn't pay in tax when he planted. So now he has to pay his taxes. And it's the 25% tax rate. And so 25% of his crop is $18,750. So after paying his taxes, he has $56,250 to live on. All right, so just to review, Farmer A paid $1,667 in taxes when he started out, and he has $75,000 to live on. Farmer B is now paying $18,750 in taxes, 11 times as much tax as Farmer A. Farmer A is how a tax-free savings account works. Farmer B is how an RRSP works. Now you can see why, for most Canadians, it makes sense to fill up your tax-free savings account with your investments before you contribute to your RRSP. All right. So now that's an allegorical way to understand it to help you remember it. But the numbers are very significant. And so let's carry on, have a look at that. Okay, so here's just a simple illustration of three people who invested the same amount of money over the same period of time and got the same rate of return, but they did it in three different formats. The blue bar is a non-registered or open investment, so it's not in a tax-free savings account or an RRSP. It's not inside any kind of a tax advantage program. The red bar is what we would call tax deferred, which is an RRSP. That's how an RRSP works. The tax that you're paying is deferred. The green bar is in a tax-free savings account, which means, like the name says, it's tax-free once you've made the investment. So for the same amount of investment over the same period of time, the same exact investment vehicle, and the same rate of return, the non-registered investment yields about $750,000 to live on in retirement. That's the blue bar. The red bar, the RRSP, yields about $1 million to live on in retirement. And then finally, the green bar, the tax-free savings account, yields over $1.3 million. So here's the question. Which is the better nest egg for your retirement? $750,000, $1 million, or $1.3 million? Now, I don't think you have to study anything to know the answer to that question, which is the $1.3 million. When making decisions about how much to live on in retirement, more is better. We want to pick the bigger number, and that's what we want to aim for. But we can only aim for it if we make the right choices in the early stages. So back here, when we make our investment, we determine whether we're putting it in a fully taxed open type of investment or a tax deferred type of investment, such as an RRSP, or a tax-free investment like a tax-free savings account. Now, you're not going to be able to put all of your retirement savings into a tax-free savings account, most likely, because you probably are going to want to save more money than you're actually allowed to contribute to a tax-free savings account over time. But you absolutely want to fill your tax-free savings account first in most cases. Now, there is one key exception that applies to many people, and that is if you have access at your work to an RRSP employer match program. So if you are fortunate enough, most people don't have what we call defined benefit pension plans anymore. Those really are there for government employees and in some union environments, but very rarely elsewhere. Everyone else, all other employers, if they offer a program, have usually gone to some kind of a defined contribution pension plan. And often a component of that is an RRSP match. And so what that means is the employer requires you to put in X amount of money to the retirement investment, and the employer will match that. I've seen many different types of instances. Sometimes they'll match 50%, sometimes they'll match 100%, some go beyond that, match 150 or 200% of what the employee is putting into the plan. But in any case, the employer match is a very nice component. So let's look at this example, and it helps to explain why you absolutely want to take advantage of this type of program. So let's say we start out with our own contribution of $2,550. And the employer matches that 100%. So the employer puts in $2,550. Now this is a registered program. So let's say if it were all RRSP, that's going to generate a tax refund at a 40% marginal tax rate of $2,040. And let's be diligent and invest that as well. So the total that we now have invested is $7,140. But we only had to put an initial contribution in of $2,550. So what that means is in the very first year, from the very first moment really, without getting any kind of an investment return, you've already got 180% return on your contribution because you put up $2,550, but your investment is already at $7,140. So that's 180% rate of return on your investment in the first year. There is nowhere else to get that kind of a thing. And by the way, that rate of return is guaranteed. So just to review where we've been and what we've said. In general, you want to put your money in a tax-free savings account before and fill that up before you start filling up your RRSP. The one certain exception to this is if you have an RRSP employer match program of some kind. Now, again, all of these are general rules, general principles, your specific situation. You should get specific advice specific to your individual situation and circumstances because there are very many different considerations to be made. And we know that we want to set out making the right investment in the right investment vehicle because 25 years later, 30 years later, when we go to draw it down in retirement, there's nothing we can do about it then. We can't change the tax treatment of it at that point. We have to make our tax planning decision at the beginning. So you really should get professional advice on this, working with a financial advisor who has the heart of a teacher to help you understand the choices that you have. All right. So another principle that we know is that the best time to start investing is when you're young. Now, preferably when you're 18 or 16 or 5 even. But the next best time to start is now. But make sure you've paid off all your debt and have your fully funded emergency fund done first. All right, so let's have a look at why starting early matters in a big way. So we're going to look here. We have the example of Bob and Dave. And what happens here is that Bob, at age 19, both Bob and Dave start working. Let's say they're working the same job, making the same kind of money, so they have the same kind of tax situation. So Bob starts out investing right away when he's 19 and he starts his work. And he decides to invest $5,000 a year. And he invests it every year from the time he's 19 until he's age 26. So he does it for 8 years, and then he just stops. He doesn't invest anything more. Now, Dave is a little slow out of the blocks here, and he doesn't start his investing until he's age 27. But he starts investing at the same rate at age 27. He starts investing and puts in $5,000 a year. And from there, he continues to invest $5,000 a year until he reaches retirement, all the way through to age 65. Now, we see the total that's accumulated. This is just using the same rate of return on the investment for each of them over those many years. So let's go back and look again. Bob started at age 19, only put money in for 8 years, and stopped after he was age 26. Dave didn't start till he was age 27. So Bob invested 8 times 5,000. Bob only put in $40,000. Dave started when he was 27, put in $5,000 a year till he was age 65. So Dave invested, he put in a total of $195,000. Good for him. But here's what happened. At the same rate of return for the same type of investment, Bob's total grew to over $2.5 million. And Dave's didn't quite get to $2.2 million. Bob invested $40,000. Dave invested $195,000. And yet, Bob ended up better off. And the reason is time. Bob's money compounded for a longer period of time. And that is the effect of compounding, especially in the later stages of investing. This is why it's so important to start young. And if you haven't started young, start now. That is the one factor you can control in investing. You can control when you start, and you can control how much you put in. You can't control what happens in markets. You can't control rates of returns, but you can control your own behavior. We've talked a lot about behavior in this course. So it's not timing the market. That doesn't work. It's time in the market. So in this image here, you can see there's 3 different scenarios where individuals save $5,000 per year and all earn exactly the same rate of return. Susan starts, in this case, at age 25 and then stops at age 35. Bill starts later at age 35, but carries on until age 65. Chris started out at the same time as Susan, but he kept on investing all the way through to age 65. Susan's investment grows to $642,000. Bill, who is the laggard of the bunch, put in 3 times as much money as Susan, but his only grew to $541,000. In other words, he ends up about 17% less or so. Now, Chris puts in only a third more than Bill, but Chris puts in $200,000 over the longer period of time, only 1/3 more than Bill, but he ends up with more than double what Bill does at $1.14 million. So, again, to emphasize, when is early? It's just sooner rather than later. Don't fret about it. If you're not young, if you haven't started early, start now. That's the most important thing. Of course, after you've got rid of your debt. Now, we're not going to spend any time tonight talking about investment types or investment selection. We're going to talk about that next week. But here's a couple of questions. Who sells the most investments in the country? Banks do. And when you go into banks, there's 3 places you get advice based on their assessment of the size of your wallet. And believe me, they know that. So you want to be making your investing decisions with an advisor, with the heart of a teacher, who is on your side and in your corner. And that advisor needs to have access to the wide range of investments, not just to a few little investments that their particular company sells. All right, so I want to cover another key topic in your retirement planning. What about government benefits? This is a topic that people have lots of questions about, or actually maybe lots of assumptions about, but they don't necessarily know the real facts. And so we want to talk with a bit of detail about the 2 biggest government benefit programs for retirees in Canada. Now, the first one, of course, is the Canada Pension Plan. CPP is, when we talk about the Canada Pension Plan, most people are thinking about the retirement benefit portion of the Canada Pension Plan, though there are many other benefits. Now, CPP, Canada Pension Plan, the retirement benefit, is based on your history of contributions made while you earned an income. For the retirement pension, you can apply for and receive the full CPP retirement pension that you are eligible for at age 65. The maximum age 65 amount of pension benefit for 2019 is $1,154.58. Now, it's important to note that the minimum amount that you might receive from CPP is $0. And that's because CPP is based on your history of contributions made while you earned an income. So if you never earned an income and you never made contributions to CPP, you would receive $0. Now, that doesn't happen to many people. Most people have worked at least a little at some point in their life. The average benefit, the average age 65 retirement benefit that people take is $724. Now, a lot of interesting things to note about Canada Pension Plan. You can also receive it as early as age 60. You can take it, it's up to you. You can elect to take it at age 60. If you do that, there's a permanent reduction in your monthly benefit. Or you can take it as late as age 70, and there's a permanent increase in your monthly benefit. So if you take the CPP retirement early, the retirement pension early, it is reduced by 7.2% for each year you receive it before age 65. That means that an individual who starts receiving their CPP retirement pension at the earliest possible age of 60 will receive 36% less than if they had taken it at age 65. Now, the opposite is true if you delay. If you take your pension after age 65, your monthly payment amount will increase by 8.4% for each year after age 65 that you delay receiving it. Up to age 70 is the maximum time period that you can delay taking that and increase it. This means that an individual who starts receiving their retirement pension at the age of 70 will receive 42% more in monthly benefit than if they had taken it at age 65. But wait, there's more. There's also a post-retirement benefit. So if you continue to work, if you start drawing your CPP pension and you continue to work, after that, you can elect to continue to contribute to CPP if you're under age 70. And your CPP contributions then would go toward what's called a post-retirement benefit, which is going to give you some additional income there when you reach age 70. Now, whether you want to do that or not, that's a rather complicated question of costs and benefits that you would need to look at if you were in that position. But there are a surprising number of people who do that. They start drawing their CPP and then they continue to work or go back to work somewhere else. Now, as I said, the Canada Pension Plan, when people think about it, generally are thinking about the retirement benefit. But there are a number of other benefits associated with the Canada Pension Plan. There are disability benefits. Now, they're hard to qualify for, and they're not the greatest, but they are there. So if you're under age 65 and become severely disabled, such that you can't work anymore, you might receive a monthly benefit. The survivor's pension is another feature of the Canada Pension Plan. So when you die, a pension may be paid to your surviving spouse or common law partner. There's also a death benefit that maxes out at $2,500, kind of what you would think of as burial money. So if you die and you're a CPP contributor, that death benefit provides a one-time payment to your estate. There are also children's benefits. So if you die or become severely disabled and you've made sufficient CPP contributions, your dependent children may receive a monthly payment from your Canada Pension Plan. So just to quickly review, the most important thing that people focus on and what the topic of what we're talking about tonight is the retirement benefit of the Canada Pension Plan. You can receive a maximum of $1,154. Not a lot of people get that, but you can. The average age 65 individual benefit right now is $724. You're going to see in a minute, after we look at OAS, that why 70 is the new 65, or maybe even the new 55, depending on your thinking, in terms of retirement planning for many people. So the other major benefit program, and let's clarify, because Canada Pension Plan is not a benefit program. Parts of it are, but Canada Pension Plan is something that you have funded with your contributions, and your employer funded with contributions on your behalf while you worked for them. It is your money. It is supposed to be a proper pension plan. It has some of those features. It's not entirely a proper pension plan, but you can draw a reasonable amount of income from that will help you in your retirement. So old age security. Old age security is not a pension plan in the sense that anyone is contributed directly to it. It is a social program. Eligibility is based on citizenship status and residency history. So for most of us who were born in Canada and have always lived in Canada, we are going to qualify for 100% of the old age security benefit. If you were not born in Canada, or you lived outside of Canada for a period of time, an extended period of time, you may not qualify for the maximum amount of old age security. Now, you can also qualify for the maximum amount of old age security if you are a citizen who was not born in Canada, or a legal resident. But there's a bit of a complicated formula there in terms of how long you've been in Canada and whether you've always been in Canada. Now, the earliest age to take old age security is 65. You cannot draw it earlier than that. And the standard benefit, so the full benefit for 2019 is $601.45. But you can make it bigger. You can defer, just like CPP, you can defer receiving your old age security pension for up to 5 years and receive a higher amount. If you delay receiving your OAS pension, your monthly pension payment will be increased by 7.2% for every year you delay receiving it, up to a maximum of 36% increase at age 70. Now, one more note, it is means tested or income tested, and it can be clawed back, and it is clawed back. So if you in retirement are receiving retirement income, and it depends what type of income it is to a certain extent, but if you're getting up into the $75,000 to $85,000 range, you may start to see your old age security clawed back a little. Most people don't experience that, and very few experience a significant clawback of old age security. But it definitely can be clawed back. Now, you really need to know where you stand. So here's the maximum amount that you could receive from these government benefit programs. The maximum combined old age security and CPP benefit for a couple who delay taking all those benefits until age 70, that combined total for the two people could be as high as $1,636 for OAS and $3,279 for CPP. Sorry, I've misquoted that. The maximum amount combined total for two of you would be $4,914.94. That would be made up of $1,636 of OAS maximum for two of you and $3,279 of CPP maximum for two of you. So a couple that delayed and was receiving the max on both programs could bring in as much as $4,914 per month from those programs. One thing to bear in mind about these programs, that income is all taxable income when you receive it. Now, I highly urge people to know where they stand on these programs. And you can do that more easily than ever now. If you can call the Service Canada line, but as you probably heard in the Auditor General's report recently, wait times on those calls are long, and often you can't even get in the queue. So the best way to do it is to get set up online. Now, you may already have gotten yourself set up online to look into this information, because if you've been dealing with Canada Revenue Agency, filing your taxes and such, you may already have your account set up there. Now, if all you've been doing is net filing your taxes, there is an additional step you have to take in order to get fully set up on the Service Canada website for that, but it's doable. You can find out there what your projected Canada pension plan will be. The OAS is easy to figure out. It's just a formula. You can drop me an email if you want, and I can help you with that. But for most people, they're going to receive the maximum. It's only if you were not always a citizen of Canada, or you've lived outside of Canada for extended periods of time, that would be affected. You can go to the canada.ca website and follow the appropriate links there to get into My Service Canada, it's called, where you can get all that information. It may take a little bit of setting up at first, but it's well worth it, and you will always have access to that very valuable and changing information over time, because obviously if you're 35 years old, the projection of what you're going to receive from Canada Pension Plan is probably premature, because your best earning years hopefully are still ahead of you there. Now, one other big question we get in all of this: can I depend on government benefits? There's been a lot of chatter over the years, especially from financial advisors, who say, oh, don't count on that, you can't count on that. Here's the facts, and here's my opinion. The facts are that, yes, the Canada Pension Plan at one stage was very significantly underfunded. And there's a lot of demographic shift going on in there. Of course, as these programs were started really during the baby boom period. And so we went through a very extended period where the proportion of people who were working to the proportion of people who were not working in Canada, that was a big number. There was a lot of people working for every person that was retired. That has been shifting as the baby boom generation, that big demographic bulge, is getting older, and that ratio is reducing. What's happened then is, rather than paying everybody's CPP benefits out of only today's contributions, that won't work. That would fail. So what you've seen over the years, of course, is our Canada Pension Plan contributions have gone up quite significantly, and they continue to rise, painfully so. That's the bad news. The good news is Canada Pension Plan is properly funded now. It will be there when you go to retire. And so, yes, I believe that you can depend on that government benefit. That money is set aside, and it's managed well by an organization called the CPP Investment Board, CPPIB. They're one of the biggest fund managers on the planet because of the amount of money in there. Old age security is a little different because it is a social program. It's not being funded other than out of general tax revenue. And so the problem with that, of course, is that government costs continue to go up, government debt continues to rise. However, for the government to roll back or disqualify people based on OAS, that would be a very difficult political move. In fact, the previous government, the Conservative government, did that. They moved the eligibility age for OAS out to age 67. Just personally speaking, I think that was a wise move. Unfortunately, it's a political football, and it's been moved back to age 65. And the only reason I think it's a wise move is because it just takes a little less financial pressure off the benefit itself. And if people plan, they can plan for that. We are living much longer. lives than we used to. We are much healthier than we used to be. When these programs first began, people didn't live that long in retirement. They didn't live a long time past age 65. Whereas now, as we can see, here's what I'm talking about. In 1950, the median life expectancy, which means half the people died before and half the people died later, the median life expectancy was 66.8 years for men, 71.6 for women. Fast forward to 2011, and it's 79.3 years for men and 83.6 years for women. Now, bear in mind, this is not the age at which everybody's going to die. This is the age at which half the people have passed away who were born. And so half the people are going to live longer than this. When we do our planning for clients, we base it on age 95. And we want to be sure that they're going to have at least enough money. And for a couple who reach age 70, a married couple that reaches age 70, there's a 25% chance that one of them will reach age 95. And those numbers are getting higher all the time. And these life expectancy numbers are getting higher all the time. And it's really important that we plan with that in mind. Because as I said at the beginning, it's very difficult if you're 89 or 91 years old and you're maybe still getting your OAS and a modest amount of CPP, but you don't have any other money, and there's only one of you surviving now. It can be very difficult to live. And going back to work is not an option for most people at that age. One more thing to note in these statistics here, you'll note that in 1950, women were living 4.8 years longer than men. And in 2011, women are living 4.3 years longer than men. And by the way, those numbers have moved out even since 2011, and they're going to continue to move out. You'll notice that there was a significant jump of 2 years almost from 2000 to 2011. Those numbers are going to continue to push out, both through medical advancement, also for men especially, because most men are not working in as many dangerous jobs as they used to. So fewer men are dying on the job. And we're just better environmentally aware, so there's less disease coming from some of the things we used to do. Things like smoking are being reduced, and et cetera, et cetera, et cetera. So these numbers are going to continue to push out. The point I'm making about the gap between men and women is that women are generally the ones who are going to live the last 3 to 5 to 10 years of their life without the supporting income that's associated with their husbands. And so, and they're also going to be responsible for managing whatever finances they have at that point. So it's very important that women have a financial plan, just as it is important that men make a financial plan. All too often we see, and I think this may be shifting demographically now, but certainly historically we've seen that men have been taking care of the money, watching, not on a day-to-day basis, that's actually is more the domain of women in families, but men have been more the ones who've been making the long-range financial planning decisions, or not making them, but they've been the ones who were theoretically responsible. And what's happened now is women, when they're old and their husbands pass away, are faced with dealing with this when they really aren't that clear on what's been going on all those years. And I've seen some really tragic and very difficult examples of that. So just a heads up that everybody, and we know this, we believe in this as a practice, Mike and I, that it's really important for both people in a couple to be fully on top of what's going on with the finances. All right, well, that gets us to the end of what we wanted to talk about from an investing point of view tonight. We're going to talk more about investing next week at a specific level, kind of fund selection, types of investments, index funds, ETFs, fees, working with an advisor, all that good stuff. And so that ends our presentation for tonight, and we'll throw it over
Woo!
to questions.
Yeah, good job. It was awesome.
Thanks, Mike.
I've got a few questions that have come in here, and actually, I got one that I'll personally ask.
All right.
Is there any way we can opt out of CPP?
Sorry, is there any way we can what? Augment our CPP?
Opt out of
Oh,
CPP.
opt out of CPP.
Yeah.
Well, no and yes. If you are self-employed, that even won't really get you out of it. In fact, if you're self-employed, you are going to pay both sides. You're going to pay double CPP.
Yeah. What about corporation?
It's possible, I suppose, if you really structured your world in that way, that you might avoid CPP if you were not drawing any money as an employee of your corporation. That you might find a way around that. That's not a structure that's probably viable for most people. And I'm actually, because of the appalling savings rate we have in Canada. While I'm not an advocate for more CPP or increasing it, I think that it keeps a lot of people who don't do any planning or don't take responsibility for their future, it keeps them out of real abject poverty, if they've been working, of course. Now, the one way to really get out of paying CPP is don't work. And so that's far less frequent now, but of course, historically, we've had stay-at-home parents, primarily in the past mothers, who may have gone many, many years or most of their lifetime without working.
Yeah.
And they would not be receiving much, if any, CPP at all.
Yeah. Yeah. Huh. Interesting. All right. So I've got a few more here. Let me ask you this one. This question came in and says, "Hello, my son is a year old and he has gotten some money from his birthday and some jobs that he has performed at Fisher Price, around about $100. Doing all that, I would like to put that money to work for him, but I'm not sure which account will be best to put his money in. Put his money in so that when he's a young adult, he may have some money to start his own projects or financial life. What advice would you have for this person?"
Well, for someone that young, if it's a reasonable to modest amount of money, I would probably recommend putting it inside an RESP, a Registered Education Savings Plan. Primarily, well, for two reasons. One, you get a nice government match on that of 20% annually, and that money grows tax sheltered until that child goes to school and then can withdraw that money. They'll pay tax on it then, but of course, if they're going to school, they're likely not making a lot of money and so not paying much tax, if any. That would be my first thought. They cannot put it in a tax-free savings account because you don't start accumulating TFSA room until you're 18. Other than that, I would probably just put it in some kind of an open investment. The thing about putting it inside any kind of an RRSP at any point is you're really tying up that money or making for kind of an ugly scenario if you withdraw it. So
you're saying skip the RRSP and go either to an RESP or into some sort of open investment.
Yeah, that would probably be where I would go with it.
Okay. Now, will he, if he goes into an open investment, will he have to now do a tax return every year? Because
yes, if you're going to invest, you're going to need a social insurance number. Also true for an RESP. So they have to get an now.
Well, that's usually they're given that now when they're born, so that's kind of a given.
Really, that comes with the kid, does it now?
I think it does. I thought I had 3 for my kids.
It could be. It's been a long time since I had kids, so.
But I thought that kind of just came with the territory now.
Right.
Let's assume it does. Then he could do an RESP or an open investment account to which he'll have to do a tax return. But let's be honest, he's not making any money, so taxes paid.
And still, there's going to be limitations on where they can invest the money in the sense that the parent is going to have to be owner of the account in many cases because a minor child can't enter into a contractual agreement.
Yeah. Yeah. No, that's true.
Laura Lee says, I don't think it does. I think she means that the social insurance number isn't coming out with the kid, that
Oh,
you have to apply for that.
then maybe we just went and got them for
Probably
our
did. We were
kids.
probably on top of that.
Well, I'd say my wife is.
Yeah.
um, okay, here's another idea. Actually, now that this came about, could the parent put the money away in a TFSA under their name in trust and have it in trust to the kid, or give it to the kid when they turn 18, 19, whatever?
Could they? Well, not in a structured legal way, because there can only be one annuitant on a tax-free savings account, and
Okay.
so you can't set up, like, you could certainly set up an in trust for account, like a parent could set up an in trust for account for the
Yeah.
child. That would just be an open account, and manage the account that way for the child. But yeah, there's no way to get it into a tax-free savings account that is in any way connected to the child. Of course, a parent can put money if they want in their tax-free savings account and in their own mind have it earmarked for their child.
Yeah.
But
Yeah.
hopefully they're maxing that out for their own retirement purposes.
Okay, good, good. Well, here's another question. Kevin wrote this one, and it's a bit of a long one, so bear with me as I go through this. All right, I have a mutual fund with approximately $250,000 in it. Excuse me. The money is currently our full retirement. I was in an accident about 8 years ago and do not work. So it's a growth and income mutual fund. And it brings in approximately $1,700 a month in income for Kevin. Um, Now, so he does not roll the $1,700 over. It simply goes into a money market account where I guess they access it as part of their income for the month to cover bills and stuff.
Right.
Yeah, and so he says, we have used it. However, we believe if we tighten our belts, we could do without it. It's an aggressive fund, and he's concerned that if he keeps the base in the fund, that when the market drops, he could lose everything. Basically, he's saying he could lose the retirement. So if they were to make cutbacks, and with their current budget, cut some things out of the budget, and the current income that his spouse brings home, they think they could go without the $1,700 a month. And so what they're asking is, do you suggest go without the $1,700 a month and then get out of the aggressive account there? And he's asking if you suggest that they do this, or do you suggest that they stay the same, or are there any other options based on their current situation?
Well, how old are these folks?
They didn't say.
Approximately?
They didn't say.
Okay.
Yeah, there's no indication here as to how old they are.
And so, sorry, right now, did you say it's actually in an RRSP right now?
Yeah. It's in an RSP through. Yeah, they're investing into a mutual fund growth. They
Okay,
got a growth and income. So basically, they got 250K in a growth and income fund,
sure.
and
So
which is bringing
that,
them roughly about $1,700 a month.
right.
Salary.
So,
Yeah.
so that's a complicated tax planning question that's very specific to their situation, but, and so by no means can I give specific advice about them particularly, but
Yeah.
a few things that I would be looking at. One is I would definitely be looking at it from two vantage points. One is making sure I'm saving enough for retirement. Since March 2009, right? Markets have been very favorable. And so, drawing down, but essentially they've been drawing out profit from their investing.
Yeah.
And, so, okay, that is what it is. But of course, what they're doing is they're deflating all the horsepower out of this great long period of growth we've had, and they've lost out on that, or they've spent it. I won't say they've lost out on it, and I'm not criticizing their individual situation at all, because I don't know it. you know, but they're, from a long-term retirement investing point of view, that money should have really grown a lot over the last 10 years. And it probably hasn't grown much because they've been taking the profit out of it. Now, for their particular situation, and depending on the nature of his disability, it's possible that they might even look at something like a registered disability savings plan. That again depends very much on the nature of the disability and on their age and on whether the disability is permanent, et cetera, et cetera. But that's a registered program that, you know, it's one of those things that government actually got right. It's a fantastic program for a small segment of Canadians who are permanently and significantly disabled. And you have to be under 50 to be contributing to it. So, you know, a whole bunch of things to look at there and whether that is the right place for it. But the nice thing about an RDSP is the government contributes in a bunch of money as well, and some provinces do as well. But other than that, I would say yes, if that money is earmarked for retirement, they definitely want to stop tapping into that and let it grow for it to get to where they need it to get to. But that is just a calculation, right? And that's what we're going to look at on Tuesday is, you know, getting to that core calculation of how much money do I need to accumulate in order to live the lifestyle that I want to live when I retire. And, you know, one of the funny things, well, it's not funny, it's actually very concerning to me because I work with a lot of clients about, you know, hey, you know, let's plan for your retirement. And that's what they want to do. And the first step for that is like, listen, here's a budget. You need to figure out how you want to live when you retire. And it's a long budget. And of course, you're trying to project well into the future. But that's where you start to get the number that you want to live on if you want to get accurate about it. Most people don't even want to do that work. I don't know why. I try to get them, you know, to me, it's not a depressing task. It's an exciting task. Like, how am I going to live when I reach that point?
Yeah.
But, you know, you need to take that step. And once you get that number, you can figure out, okay, how much do I need to accumulate? And then you can determine from there how much you need to be saving now.
Yeah.
So,
okay. All right. So yeah, stop taking that money out. is what you're saying. If you can live on a budget and not have to spend it, put it back into the account, let it grow.
right.
I'm thinking with the rule of 72, that 250 over the last 10 years or so could easily have doubled.
Oh gosh, yeah.
And a growth and income fund
and that would be with less risk than they probably have in their current investment profile.
Yeah. Okay, cool. Okay, so Philip asked this question. Now that I'm debt-free and have an emergency fund in place, how do I calculate my next move in terms of investing?
Well, I would say, again, the first place you want to start is figuring out how much money do I need to be setting aside to reach my goals. And depending on his age, of course, that could be multiple goals. It could be maybe saving a down payment for a house. It could be setting aside money for education and saving money for retirement. If you don't have enough to cover those three, you definitely want to be saving for retirement first and foremost. It follows that principle of, you know, the oxygen masks dropping down on the airplane when it's in trouble is like, parents, please take care of your own oxygen needs first and then help your children, because we want you to be able to help your children. And so we need to take care of our own retirement. We need to make sure that that's set up before, if necessary, before we look at other things. But hopefully they're in a position where they can be moving down all three tracks concurrently. That is, saving some money for education for their kids, if that's part of their equation, saving money for a down payment if they don't have a house yet and that's what they want to do, and of course saving for retirement. And rule of thumb, you know, we like to see people saving 15% of their income for retirement, but we can come up with a much more precise number for individuals. And again, that's part of what we're going to look at on Tuesday.
All right. And then here's another one. Jennifer asked this one. I currently have an RSP through my employer, and I've been with them for 18 years. My question is, I'm not investing anywhere else. So, should I start investing in an RSP or TFSA?
Well, the answer to that question is you should consult with a financial advisor with the heart of a teacher who is not associated with your workplace savings plan. Now, things may be perfectly fine. It really depends on how much is going in there. Generally speaking, people are not saving enough in a workplace RSP. And also, the investment options in a workplace RSP are usually not that great. And unfortunately, what people tend to do is they treat it like they're just filling out forms because they're given these forms by their group plan administrator. And it supposedly is assessing their suitability for certain types of investments. But generally speaking, those questionnaires all point in the direction of getting what's called, well, I'll call it age-based or age-centered investments. Target date is what they're referred to, target date types of investments. So if you're 45, you should be in this investment profile, blah, blah, blah. It's all totally automated. And generally speaking, the results have been pretty dismal in most of those plans.
Are you telling me they got monkeys?
And they're not even smart monkeys.
Oh, boy.
No. The monkeys, I think they're drunk monkeys, actually, is what's going on there.
Oh, boy.
Now, it doesn't mean, like, it's not automatically that if you're in there, it's bad. I mean, maybe there's enough going in. Maybe. Usually there's not, because usually the employer match has a cap on it. So the employer won't match enough that you could be getting a full 15% going in there.
Yeah.
And again, the investment returns, unless you've had somebody really look at it. So for example, I've worked on my wife's, and we go through it every year and we drill down through it, and the investment options are not great. There's a few that are sort of okay. Most of them are somewhere between just sad and pathetic. And, but I know that most people in most of these types of plans aren't going through that type of analysis and really taking a look at it. And that's why I say, get someone who's an advisor with the heart of a teacher. And they're really going to have the heart of a teacher on this one, because they may not make any money from performing this service. So they have to want to do it, or make an arrangement with you, whatever that is, because there's no way for an external advisor to kind of take control of those investments for you.
Yeah. Yeah, I hear you. Okay. Okay.
We have another question here about someone
about
that has, someone has money in a lira. Bank told me to come in and talk about investing it. Well, of course they did, as they would. I'd like to invest aggressively. Do you have any suggestions? Well, my suggestion is, this is the type of thing we're going to talk about next week. We're going to look at investment selection. And then the question, should this go into a bank lira, or is there somewhere else it should be deposited? And the answer to that is yes. You want to figure out who you want to work with and how you want to work with them, and then work with them to help you do that. So, you know, I'm not saying never deal with the bank, though that's mostly my philosophy. But
you don't want to deal with monkeys.
Well, and it, you know, it's not only that, it's that, you know, depending the level of, and I mentioned earlier, you know, that the banks kind of have triage they do on you. You won't see it happening, but they determine who you're going to get to see based on their assessment of you. Yeah. And so there are, you know, fully fleshed out independent investment advisors in kind of the more elite boutique aspects of the bank channel. But mostly you're getting people who are dealing with formulas, and they are, if they're not constrained to, they're at least very much focused toward flogging bank products. So you're not getting kind of the full picture of everything you could be investing in. I'd also say that if your goal is to invest aggressively, Probably the forms that the bank hands you to supposedly gather information are not going to point at that. They almost always point at balanced funds because it keeps the banks from getting into trouble.
Yeah.
You know, it's mentioned that it might be at a credit union, and really mostly the same applies. You know, credit unions aren't quite as hyper focused on their own. Well, they're not as hyper focused on their shareholders' best interests because their shareholders are their members. So it's a little different at a credit union, but still the best interest first and foremost is not for the client, it's for the organization.
Yeah. And if I could add to that, I had a buddy who used to work in the bank. He used to be the training guy in the bank. And I can tell you the bank's interest is not your interest.
Yeah.
Based on talking to him a bunch of times, the bank's there to make money for their shareholders, and they're not going to get you. They don't have you in mind. And so I would say one of the best things you can do is go work with a broker, or go work with someone who has more options than just what the banks are going to give you. And so you should go and contact this guy. I know his name is Brad Macbeth. He would he can help you with that probably a lot better than the banks or the credit union will be able to do for you. And I believe you're licensed in Ontario, right?
Also true.
Yeah, so you can totally take care of this one. No pressure, but I would say I think you'll be in better hands than with the bank.
Well, and the fundamental thing I would say is you should have a written plan, and if you've got money invested anywhere and don't have a plan, and that's actually the case for most people, then I have no idea what people are doing. And I'm not throwing that on the investors. I mean, it is up to them to look after their own affairs, take care of themselves, protect themselves. But there's all these advisors and banks out there, you know, that have all this money invested across the country. And in all the years that I've been doing this 16 years now, the first question I generally ask people is, do you have a financial plan? They'll kind of go,
what's that? Kind of, yeah.
And then I'll say, okay, great. Can you show it to me? And then they'll hand me one of two things, invariably. They'll hand me either just an investment statement. So, you know, maybe they've got some money in an RRSP, and so they show me that. Or they have the forms they filled out, what's called the Know Your Client forms and the risk tolerance questionnaires from when they first got their investment, which again, they aren't a plan of any kind. They're just gathering some information. And not once, I kid you not once in my 16 years of doing this has anyone actually handed me any kind of a written financial plan. And so there's no reason people shouldn't have one. It doesn't have to be complicated. You know, it doesn't have to be 3 inches thick. If you're wealthy and have lots of moving parts, maybe it is. But for most people, you know, half a dozen pages should be able to really map out an awful lot of stuff that's important.
Yeah. That's awesome. Well, thank you for that, Brad. We should let everyone go. We've been on this for an hour and a half.
We have.
We're doing overtime here, and I want to get to the Boston game and see them.
That's right.
But so next week you'll continue the conversation.
Yes, absolutely. Tuesday we'll be live on Facebook, so we'll send out a message with
Eastern.
that link. 2 p.m.
Eastern, 11 Pacific. Yep.
Yeah. And we're going to be looking there very specifically at how you can calculate how much money you should be saving and how much money you're going to need for retirement.
I love it. And I'd love I don't know if you have time, but talk more about this financial plan, how to put one together maybe.
We're going to talk about that next week. Absolutely.
Cool. Good.
Definitely.
Awesome.
All right, Mike. Well, it's been great being together again.
It was, and we'll see you Tuesday.
You bet. Thanks. Take care. Have a great night, everyone.